Is there still time to invest in GICs? We know the Bank of Canada has hit the pause button on future rate increases. Could this mean that the GIC percentage return will stay flat from here or potentially go down? We'll take a look at a few things in this video, especially with where we're sitting at today in terms of the best GIC rates in the market. And I'll give my thoughts towards the end of the video as to whether I would be investing today in GICs. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. It's been 9 months since we first covered the topic of is it time to invest in GICs? And during that video, I had one hesitation, and that hesitation was the fact that the inflation rate was higher than the interest rate on the GIC. So when we take a look at this chart here, we can get an indication of what the inflation rate has been in Canada over the past year. And in July, when we made this video, it was 7.6% in terms of what the inflation rate was. In regards to what the GICs were at the time, they were just approaching 4 to 4.5%. So there's about a negative 3% dispersion there. And now that we look at what the inflation rate has done, I'm sure we're all kind of understanding of where inflation has been over the past year because it's such an important topic. But the most recent number came out for March and we are down to 4.3%. So we'll discuss a little bit why this is a huge factor now that inflation rate is now below what they are paying out on a GIC. So it's starting to become positive in terms of where this potential inflation rate could go over the long run. So I know we mentioned that the inflation rate for March is down to 4.3%, but what I wanted to highlight in this article is that the Bank of Canada is expecting the inflation rate to hit 3% in just a few months. Now, why is this important? Because it's starting to fall in their target rate. So every year, the Bank of Canada says that we want inflation to go up by 2 to 3%, and that has been their goal over the long run. And because the inflation rate was skyrocketing, that's why interest rates had to move so high so fast in this past year. Now, why is this important? Well, it's important because what my hesitation was originally, in the sense that inflation was higher than the interest rate, now we're starting to see a little bit of a change. We'll take a look at what the GIC rates are today to get an indication of how that compares to what the March inflation rate is. This article here will give you an indication of what the top GIC rates are, obviously in Canada, as of April 19th of 2023. And some of the numbers that we see on a 1 year are highlighted in the sense that they are actually higher than the inflation rate, which means that when you look at your real return, which is your inflation rate minus the interest, we're actually going to be in the positive figures. So when we click this 1 year term, we can get an indication of who's paying kind of the highest percentage. And we see Wealth One, Motive Financial, some of these are actually trending still above 5%. So what could happen over the long run? Well, basically it's the fact that the Bank of Canada could potentially start decreasing these interest rate numbers, which would effectively lead the GIC rates to come down as well. So I think we're still in a sweet spot where you could get a GIC 1 year term for over 5%, where inflation is on the downtrend. You know, I don't know where inflation is going to end up over the long run. I don't have a crystal ball, but I do believe that we are going to see lower numbers, maybe trend around that 3% over the next year. So right now I could get in at 5%, whereas potentially if I waited a little bit longer, these interest rates could start going down. And what I say about start coming down, when we look at this overall chart here, we get an indication that it's not only 1 year that they're looking at, they're also looking all the way up to 5 years. And when we take a look at RBC, for example, we're actually getting a better interest rate to hold our money in for the short run rather than the long run, which does not make sense at all. Typically, when you want to invest your money and you're putting it away for 5 years, you want to get a higher percentage return than if you were just to do a 1 or a 2 year. So what these numbers are reflecting right now is that inflation is going to come down, interest rates are going to come down, And realistically, there's still an opportunity to get this 5% in the short run, which is a great opportunity in my opinion. If you want to take a look at this list, I'll leave the link to the site down in the description. You can get an indication of what providers, what institutions are giving out GICs right now, and especially looking at some of them that are in the shorter term. Now, why is this important? We'll jump over to this Yahoo Finance article here and we'll see GICs are enticing, but for only the shorter terms. And this is a money manager that's saying that. And let's read a little bit as to why. He believes that GICs are best used for short-term savings goals, such as a down payment for a home, a once-in-a-lifetime vacation, or to protect retirement income from market volatility. However, the main risk of having your money locked in is when the future path of interest rates is unknown. We know that the Bank of Canada paused their interest rates back in January, and they wanted to evaluate what the impact on inflation was going to be on the broader economy. But if high inflation is more persistent than expected, more rate hikes would be on the table. Now, if they do happen to hike further, then realistically interest rates will move higher. These GIC numbers will move higher. But it's been 2 months since that point and inflation is still on the downtrend. So an investor will look like a genius if they lock in a 5-year GIC at today's returns and interest rates go down to 1%. On the contrary, they may feel frustrated if they lock in now and see the Bank of Canada continue to hike its benchmark rate. So what we're saying here in summary is that if you have a bunch of capital that you don't need because GICs are locked in, it's a great opportunity to look at a 1-year GIC that could potentially be paying more than what today's current inflation rate is. My suggestion is to find a provider that has an insured rate of over 5%, and then from there, realistically, we can evaluate what the Bank of Canada is doing, but it's most likely going to continue to pause until that inflation rate hits further into its target rate, which again is between 3 and 2%, which it is definitely forecasting by the end of the year, if not within the next couple of months. Additionally, if you do need a little bit more liquidity, there is still high interest savings account. My personal favorite is CI Financial, which is paying about a 3.75% interest. A lot of the bigger banks have promotions to stay in there. But again, if you have a lump sum of capital, you can get a GIC still today at 5%. I think this could be a potentially great opportunity to get in there. Do your own homework, make sure that you're doing the best for yourself. If you need that money within that 1-year term, the GIC is not the best for you. But obviously this is my own thoughts. If I have a lump sum of capital that I don't need for a year, clipping that 5% is definitely something that is interesting, especially now that inflation is going to be sub 4% in the next couple months. If you want to learn more about GICs, make sure to check out that video that we covered back in July here. If you want to learn more about high interest savings accounts, we covered the top ETFs. Check out this video here. I hope you enjoyed the video. If you're still here, make sure to hit that like button. I hope you all have a great week in the markets. Happy trading.